In today's video, we're going to talk about 7 retirement planning mistakes that can cost you time, money, and peace of mind. Let's get into it. Mistake number 1, planning for longevity. Now, knowing exactly how long to plan for in retirement is a difficult task. If we knew exactly how long we were going to live, retirement planning would be a whole heck of a lot easier. In past videos, not uncommon that I give examples of a retirement plan that's run into the 90s. Often in the comments, I'll see viewers objecting, saying normal life expectancy is only 77. Why would you run a retirement plan into someone's 90s? Well, life expectancy is only 77 from birth. As you age, your life expectancy actually grows. Now, this makes sense if you think about it. From birth, life expectancy data includes everyone who passes away prematurely as a child, a young adult, etc. Every year you live, you outlive those that drag down those life expectancy stats. Thereby, your personal life expectancy actually lengthens. If you're currently 60 years old, your actual life expectancy, according to Social Security data, is 82. If you're 70, your life expectancy is nearly 85. Now, keep in mind, around 50% of people pass away before this. Around 50% of people live beyond this. So even using life expectancy at any age can be taking a bit of a chance. Now, JP Morgan has a great chart laying out some probabilities for a 65-year-old. If you're married, there is a 76% chance one of you will live to 85 and a 46% chance both of you will. There's a 50% chance one of you will live to 90 and an 8% chance both of you will. And so we can see it's not aggressive at all to run retirement plans for a couple into their 90s. In fact, when we look at the intersection of individual life expectancy, we see that it's quite prudent to run a long retirement time horizon. If you don't, you may just be leaving your spouse out to dry. Mistake number 2, having no annual tax roadmap. I recently recorded a video talking about the importance of the chart that I have on the screen. It's so crucial to the tax planning process that I don't know how you can adequately tax plan in retirement without looking at this chart each and every year. This chart shows a retiree's marginal tax rate at various income levels. Now, this chart is from a 70-year-old retiree in New Jersey, and they have a $3,000 per month Social Security benefit and about $10,000 in qualified dividends. Now, this retiree needs $75,000 after tax to fund their lifestyle. Now, I show 2 different points on this tax chart. Point 1 is where many retirees will unknowingly find themselves, and where this retiree found themselves before we met. They were simply filling in the rest of their income need with IRA withdrawals, and without seeing this tax chart, they saw none of the tax liability they were forcing themselves into. At point A, their tax liability was almost $9,200 for an effective tax rate of 11%. Now, this is a pretty low effective tax rate, and so for years, this retiree found no issue with their withdrawal method when they were just looking at that summary effective tax number. But if they would have had access to this chart, they would see that about $10,000 to $15,000 of their income was quite costly. Instead, they'd want to be somewhere closer to point B and fill in the rest of their income need from Roth and taxable account assets, thus avoiding a lot of the tax pain shown in this graph. Doing so, they would have saved about $5,000 in taxes, and they see their effective tax rate go from 11% down to 5.5%. So mistake number 2 is not arming yourself with the right tools to really capture tax savings. Mistake number 3, taking Social Security early, thinking that it gives you more income in your 60s. Now, on the surface, it can seem like taking Social Security as early as possible gives you the highest income in that first decade. But this is only the case if you have little in the way of retirement assets outside of Social Security, or we're looking at a very short retirement. For instance, if you have $150,000 saved for retirement, then your only options for retiring in your 60s is probably to take Social Security right away. But for those that have meaningful savings, this idea is a common myth. On the screen, I have a chart showing the amount of income a couple could have sustained historically with a balanced 60-40 portfolio. Now, this couple is currently 62. They have a $1 million portfolio and are planning to live a 30-year retirement. And I have their Social Security benefits shown on the screen. The low point for what a client could have taken historically was approximately a $600 difference if they took Social Security at 62 versus 70. Now, because retirement planning is generally conservative in nature, This is very informative as to the income these retirees would have prudently taken. Now, we do see that when you take Social Security at 62 and the market environment is favorable, you are able to take a higher ceiling of income. But I don't know a single retiree that pegs their starting income off the best ever scenario. And so I do think most retirees should spend the most in their first decade of retirement. But I don't think that taking Social Security at 62 helps in this goal, and the data agrees. Mistake number 4, trying to maintain a certain number on a statement. On a regular basis, I meet with retirees that have a certain nest egg, say $1.3 million, and have a goal to never see their wealth drop below, let's say, $1 million. Or they have $4 million and they never want to see their wealth drop below $3 million. Typically, the number they never want to drop below is pretty close to the all-time highest portfolio value. In my humble opinion, this is a needless requirement in the retirement planning process. Optimizing your retirement plan can be difficult enough without adding in needless variables. Look, I'm not saying that everyone should draw down their portfolio to zero, or that we shouldn't care at all about the volatility that we experience in our portfolio. But trying to maintain a certain number on a statement is, number 1, sometimes out of your control. And number 2, will often lead to worse decision making and a more inefficient retirement. Here are a couple reasons why. Number 1, if you built what I will call a proper income plan, you'll be spending more in the first decade than you do in the preceding decades. This is because spending drops as you age, and you are most able to enjoy your wealth at younger ages. While spending more on the front end can mean more stress on your portfolio. What if this means dropping below that number on your statement for a period of time before rising back above it? Number 2, financial market performance is largely out of your control. The market might rise 30% in 2024, or it might fall 30%. Now, your retirement plan should be able to withstand both environments, but the number on your statement might not. Number 3, strategic tax planning in your 60s might also mean you're front paying taxes through strategies like Roth conversions. This can put added stress on your plan and account balance. The point here being your goals for retirement should be oriented towards getting the most out of your money rather than trying to maintain a certain number on your statement. Mistake number 5, focusing on income yield as a retiree. Now, many investors mistakenly think that the best way to turn your assets into an income stream in retirement is to become an income investor that focuses on income yield. Investing plans do need to adjust in retirement to often add more safety than when you are in the pure growth phase. But making decisions chiefly based on income yields is a big mistake. Income yield says nothing about the safety of income, only what you are being paid to own the given investment. On the screen, I have a few examples of investments with their corresponding income yield. Now, for an investor with an income-focused philosophy, the higher the income yield, the better. Now, keep in mind that investment companies understand this and will serve up higher income yields in order to garner more interest from these income-focused retirees. With this focus in mind, income investors will own more ETFs like covered call strategies, which I have a recent video talking about why these aren't great for retirement. They will own more real estate because of large dividends that REITs release. They will own more dividend-paying stocks in the US, and by doing so, will have less diversification because most of the high dividend stocks in the US are in utility and telecom sectors. These retirees will also own more international stocks, as international stocks have paid a higher dividend than US stocks. That investor might also own more risky bonds, as riskier bonds pay a higher yield. In many ways, income yield focused investors will find themselves taking more risk for the return that they receive. I find income yield investing akin to trying to maintain a certain number on a statement. It is adding in a needless variable that only constrains our options. Why don't we instead just try to maintain the best risk-adjusted portfolio regardless of income yields or anything else? To give you an example of what I mean, on the screen I have 5 different markets or slices of a market. Everything from a broad-based stock portfolio to international stocks to REITs. This data only goes back to 1994, but that's almost a 30-year period at this point. Across the board, every one of these markets had a substantial drawdown, and only one market was a material outperformer. Interestingly enough, that outperforming market had the lowest income yield. If you're looking for more information on the pitfalls of income investing, click here. Mistake number 6, focusing all of your energy in retirement planning on the money and financial side and leaving out the three most important aspects of retirement, which is time, health, and relationships. Money is obviously important to retirement. Without it, we'd have a hard time retiring in the first place. But I think the three variables I have on the screen outweigh money by a wide margin. Starting with relationships, there's a great book called The Good Life that is based on a long-run Harvard study that has been tracking human happiness since 1938. The study has spanned multiple generations and found the number one contributor to happiness across the board was strong, deep relationships. These relationships can be with your spouse, your family, or your friends. As human beings, we are social creatures, and loneliness can be as detrimental to your health as being overweight or unhealthy in another manner. Retirement is a fantastic time to rekindle and put a greater focus on relationships that have been ignored. Next, we look at time. Now, retirement gains you an abundance of time, and it is what you do with that time that will create more value in your life than any amount of wealth ever could. Waste away that time in front of the news each day and you will find retirement absolutely miserable. Use that time adequately to focus on relationships, health, hobbies that give you energy, and you will find retirement being the best phase of your life. Finally, we have health. Our lives are nothing without health, and this is never more apparent than when we are feeling unhealthy. Health is the prism through which we view the world, and luckily, we can do loads to affect our health. In Peter Attia's book, Outlive, he talks about a concept called health span. Health span is not how long you live, but rather how long you live and are healthy living. Most of the population follows the black line on the screen where retirement is mostly a downward trajectory to unhealthiness. Aging, after all, is hard on the body. But the degree at which it is hard can be affected by you and the work that you put in. And so do yourself a favor. For every minute that you put towards your finances, put, 5 to 10 times the effort towards your health, your time, and your relationships. You want an income yield? This can be the greatest dividend that you pay yourself. Finally, mistake number 7 is paying too much attention to the noise. Now, noise is all around us. The news is 99% noise. Most content is 99% noise. Hey, maybe even this video is just a bunch of noise. I find that noise is all around us and often negative in nature. What bleeds leads, as the saying goes. If a news outlet posts the next decade will be the golden era in America versus they post the next decade will be the ruin of America, which are you more likely to click on? Swaths of data show that you are more likely to click on the latter. Now, Morgan Housel has a great quote on this. Optimism often sounds like a sales pitch. Pessimism sounds like someone's trying to help you. I believe there's a whole lot of undue worry due to this dynamic. But if we're honest with ourselves, how much does worrying about a given outcome actually affect that outcome? I think most of us can agree that 95% of worrying has absolutely no effect on the outcome. And I think it's pretty generous to say that 5% does. And so if there's barely any benefit, we know there is a huge cost to worrying. And so what if we just shut off the noise and gave up the worrying? What peace of mind benefit would this give us? Now, I know this is easier said than done. I struggle with this myself. Related to your personal finances, I have on the screen all of the scary reasons that you could have sold out of financial markets from 2009 to 2019. And the engine that is human innovation and American capitalism kept on chugging along, ignoring a lot of the noise. I think we can do the same. Now, I hope you found this video valuable. I hope it helped improve your retirement. If you're looking for more ways to improve your retirement experience, click on this video right here, where I discuss the 5 most important years of your retirement and why it's so crucial to get these 5 years right. Click here to learn more, and always remember, you don't need more money, you need a better plan. Thanks for watching.